Did you know that the world's wealthiest people don't rely on luck or secret formulas? They follow specific patterns that have been tested and proven over centuries. Whether it's Warren Buffett, Jeff Bezos, or any other successful person, one thing they all have in common is that they understand these patterns and apply them consistently. If you really want to create wealth, you need to recognize and leverage these 10 powerful patterns that have shaped financial success throughout history. Let's dive in. 1. The compound growth pattern, how small returns become life-changing wealth. In the 1920s, a young boy named Warren Buffett started selling Pepsi Cola bottles. Instead of spending what he earned, he reinvested it. Over the years, his money grew exponentially. Today, he's one of the richest investors in history. His secret? The power of compounding. Compounding is like planting a tiny seed and watching it grow into a massive tree. The earlier you start, the more powerful it becomes. A single dollar invested at a modest return can turn into a fortune over decades. But compounding isn't just about money, it applies to knowledge, relationships, and even business. The more you build, the more it multiplies. So, the question is, are you planting your seeds today, or are you eating them all? 2. The market cycle pattern, dancing with bulls and bears. During the 2008 financial crash, the stock market took a massive dive. People panicked and started selling everything. But smart investors, like Warren Buffett, understood market cycles. They bought stocks at rock-bottom prices while everyone else was running for the exits. A few years later, their investments skyrocketed. Markets go through cycles, booms and busts, peaks and crashes. The key isn't to predict them perfectly, but to understand where you are in the cycle. Are you buying when everyone else is greedy? Are you selling when fear takes over? The market is like a roller coaster. You can either scream in panic or enjoy the ride. Which one are you choosing?
3. The diversification pattern, building your all-weather portfolio. In the 1980s, a Japanese businessman put everything he had into real estate. He thought it was a sure bet. Then the Japanese economy crashed and he lost everything. Meanwhile, investors like Ray Dalio had their money spread across multiple assets, stocks, bonds, commodities. When one went down, the others balanced it out. Diversification isn't just about owning different stocks. It's about spreading your risk across various asset classes, industries, and even geographies. Think of it like a sports team. If you rely on just one star player, what happens if they get injured? A strong portfolio, like a strong team, is built for all conditions. So, are you betting everything on one move, or are you playing the long game? Point 4. The behavioral finance pattern, mastering your investment psychology. When Amazon stock first launched in 1997, many investors laughed at it. They thought it was overhyped and sold their shares early. Fast forward to today, those who held on to their shares are now multimillionaires. The lesson: people make terrible financial decisions when emotions take over. Fear and greed drive the market more than logic. Loss aversion makes you sell too soon. Overconfidence makes you hold on for too long. The best investors recognize these biases and counter them. Are you in control of your emotions, or are they controlling your money? Point 5. The risk management pattern, playing defense to win. A successful trader named Chris Severson had one rule: never risk more than 2% of his capital on a single trade. Others were making massive bets and winning big until they lost it all. Chris, however, played smart. Over time, his portfolio grew steadily while others crashed and burned. Risk management isn't about avoiding risk. It's about taking calculated risks with the right balance. Most people focus only on potential profits. Smart investors focus on potential losses first. Would you rather survive the storm or be the person who lost everything chasing a jackpot? Point 6. The value investing pattern, finding hidden gems in plain sight. In the 1940s, Benjamin Graham, the father of value investing, bought shares of a company that was undervalued. Everyone ignored it, but he saw its true worth. A few years later, its value skyrocketed and he made a fortune. Markets overreact all the time. Panic sells, hype inflates prices. The key is to ignore the noise and focus on fundamentals. Are you following the crowd, or are you hunting for hidden gems?
7. The dollar cost averaging pattern. Slow and steady wins the race. If someone had invested just $100 every month in the S&P 500 for the last 20 years, they'd be sitting on a fortune today. The reason? Dollar cost averaging, consistently investing over time instead of waiting for the perfect moment. Timing the market is like trying to predict the weather a year in advance. You'll probably be wrong, but consistent investing removes emotions from the equation and ensures long-term growth. Are you waiting for the right time, or are you making the time right now? 8. The income generation pattern. Building your money machine. Robert Kiyosaki, author of Rich Dad Poor Dad once said, "Your wealth is measured by how long you can survive without working." He built multiple income streams: real estate, businesses, dividends, so that his money worked for him instead of the other way around. Building wealth isn't just about saving, it's about creating cash flow. Are you working for money, or is your money working for you? 9. The entrepreneurial and innovation pattern. Riding the waves of change. When Elon Musk started Tesla and SpaceX, people thought he was crazy. Critics laughed at the idea of electric cars and commercial space travel, but he understood market trends before anyone else. Now, he's one of the most successful entrepreneurs in history. Innovation creates wealth. If you can spot trends early and act, you'll be ahead of the game. Are you adapting to change, or are you getting left behind? 10. The global economic pattern. Thinking like a global investor. In the 1990s, China was still an emerging economy, but some investors saw the potential and put their money in early. Today, those investors are worth billions. Why? Because they thought globally while everyone else was focused locally. The world is constantly shifting. If you understand global trends, you can position yourself for long-term success. Are you looking at the big picture, or are you stuck in a small frame? These 10 patterns aren't just theories, they are time-tested principles used by the world's wealthiest people. If you really want to create wealth, don't chase shortcuts. Study these patterns, apply them, and stay consistent. So, which one of these patterns are you going to start implementing today? Let me know in the comments. Thanks for watching. Before you go, don't forget to subscribe to Unrealika and check out these amazing videos waiting for you.